afternoon. Today, we are pleased to welcome back to Unlock the Stock Growthpoint. This platform was created for retail investors to connect with corporate management and to get a better understanding of them and the companies. We're joined today by Norbert Sasser, who's Group CEO of Growthpoint, who will take you through the company's presentation shortly. Unlock the Stock is only possible with our technology partner, Lumi Global. You can visit their website at lumiglobal.com to discover more about their various online AGM and investor presentation solutions. The Q&A session will be hosted by the Finance Ghost and Mark Tobin of Coffee Microcaps. But before we start, we have a few housekeeping notes. The company presentation will be followed by a Q&A session. You can post your questions by typing them into the chat box, which is at the bottom of your screen. The event is being recorded and will be available on our YouTube channel soon. You will also see an email address before we begin the Q&A session. Please take note of this address if you would like to be added to Growthpoint's distribution list. At this point, I am ready for Jonathan to share the presentation, and then Norbert, I'm going to hand directly over to you to take us through the presentation, please.
Thank you, Vanessa. Yeah, and thank you very much for the opportunity of sharing Growthpoint's results with you. This is the Growthpoint results for the 6-month period ending December 2025. Just for everybody's benefit, this presentation is available on Growthpoint's website if you wanted to download it. There are many slides and something like 67 annexures as part of this presentation. So what I'm going to try and do is just provide in a half an hour allocated an overview of the business and the results, and then we can go straight into the Q&A session after about half an hour or so. Jonathan, if you wouldn't mind scrolling through to the next slide, and then another one another two further forward. Yeah, so one more. So just on this slide, this gives an overview of the business, Growthpoint's business today, essentially made up of the South African portfolio, our offshore investments, and then our third-party fund management business. The South African portfolio comprises of mainly retail, office, and industrial logistics properties, and then we have a couple of properties in our trading and development business as well. Today, South Africa makes up about 50.7% of the total assets within the portfolio, and the South African business contributes about 58% of our DIPS. Now, in our terms, DIPS means distributable income per share. It's not too dissimilar, I guess, to a traditional earnings per share kind of number. The other major asset that we have in South Africa is the V&A waterfront, arguably our single largest asset and probably the most high-profile one. I could speak for an hour and a half just on the waterfront, but it is such a unique asset. So we own 50% of the V&A waterfront property in Cape Town. Our current book value of that is about 14 billion. It makes up about 10% of our total book value of our assets and contributes about 15, almost 16% to our bottom line distributable income number. Moving offshore, we have three remaining offshore businesses. The first one is Growthpoint Australia. So Growthpoint Australia is a separately listed entity on the Australian Stock Exchange in Sydney. We own 63.6% of the shares in that entity. It comprises about 22.8% of our total group assets and contributes just short of 19% to our distributable income number. We also then have an investment into a separately listed entity on the alternate investment market in London called Global Worth, or in short GWI, Global Worth Properties. We own 29.6% of the shares in that entity, and it makes up about 11.5% of our assets and contributes 2.7% to our bottom line distributable income. And then the last international element is a company called Lango. So Lango is a property investment company that invests in African real estate outside of South Africa. And we own 15.7% of the shares in Lango. It is a private property fund, if you want to call it that, with institutional investors investing alongside us. Relatively small in the overall scheme of things for us, with making up about 1.5% of our assets, and contributing, not really contributing to distributable income in as much as we didn't receive any dividend from this entity during the period. And then lastly on the slide, our third-party fund management business, where we effectively have two funds. The first one is a healthcare fund. GHPH stands for Growthpoint Healthcare Property Holdings. And the second one, that's got about 7.4 billion rands worth of assets in that fund. And the second one is Growthpoint Student Accommodation Holdings, or GSAR. That's got 4.7 billion rands worth of assets. Combined, those represent about 2.8% of our group assets and contribute about 4.4% to the bottom line profits of the business. So this should give you a very high-level feel for the different elements to the business. And I'll move forward providing a bit more insight into some of these and then the group performance as a whole. So one more slide forward. Thanks, Jonathan. So for the period under review, we delivered 2.3% growth in our distributable income per share to 75.7 cents. Dividend per share grew at 8.5% to 66.2 cents per share. That represents a combination of, a higher distributable income per share, but also a higher payout ratio. So this period compared to the last, we increased our payout ratio to 87.5% from 82.5%. Our group loan to value ratio sitting just over 40%. This number represents effectively the total debt that we have relative to the value of our assets. And then total group consolidated assets grew by 1.1% to 157.5 billion rand. Our net asset value per share was down by 2.2% to 19.45 rand. And then our group interest cover ratio increased from 2.5 times to 2.7 times. And if we isolate the international businesses and look at the South African business only, the South African interest cover ratio increased from 2.9 times to 3.2 times. So in essence, a conservatively geared business with ample cover, if you want, in terms of net profits or net revenues, having to cover our interest expense. Just moving forward to 2 slides and touching on our strategy. So it's been a pretty busy period the last 6 months, and I guess it's fair to say that the business has really gained some positive momentum in the last 6 months, and probably even a bit more, maybe the last 12 odd months. So it's been a pretty tough old time for listed property companies generally. Having come out of COVID and having come out of load shedding and having come out of high interest rate cycle, certainly the low interest rate cycle has been very beneficial for the business and a key driver of the results. I'll speak a bit more about that shortly. But yeah, we did return to positive distribution growth at the end of last year. We're continuing this positive momentum and showing improved positive growth in earnings again this reporting period. During the period in August, we disposed of the remaining of our UK investment that we had, which was a stake in a company called New River REIT. And that was completed in August. Moving through into October, we made quite a significant acquisition for the fund management business. The healthcare fund acquired the Aurea business. That's about 3 billion rand worth of assets. The net equity check there was about 1.2 billion, which was settled in cash. We invested 50 million rand into the Boston Hydro project. This is part of our broader ESG strategy to tap into green energy, and we acquired a 30% stake in a hydro plant generating electricity out of the Lesotho Highlands water scheme project. We also in October 25 made an investment into the Cape Winelands Airport, which is a new domestic and ultimately international airport that is under consideration here in the Western Cape, giving us a lot of optionality in terms of future investment into all things ancillary to the airport, including logistics facilities, industrial parks, and the like. In January, just shortly after the December half year, we also got the good news that at the V&A waterfront, we achieved the additional rights to expand the V&A waterfront footprint. Not the footprint so much, but we got additional rights on the existing land footprint, and that amounts to some 440,000 square meters of bulk, providing, I guess, future development opportunities and expansion opportunities at the waterfront for the best part of the next 10 to 15 years, I'd say. We also, in February, post the half-year mark, disposed of the Discovery head office building in Sandton. Pretty significant transaction, combination of the sale and the acquisition into the phase 2 building. We'll realize a net 2 billion rand worth of proceeds from the disposal. And then we've made some very significant commitments in terms of additional investment into logistics and industrial facilities. One facility in KwaZulu-Natal, another in Cape Town, and another in Gauteng, so pretty diversified across the country. And then lastly on this slide, we also announced and had the sod turning ceremony for the development of the Olympus residential scheme in Sandton. This is adjacent effectively to the Discovery property in Sandton, in what we call the Sandton Summit Precinct. And this development will take place over the next sort of 18 months. Very high-end luxury apartments being built in the Sandton area. And we're doing that in partnership with a residential developer called Tricult, who have developed very successfully residential developments in the Waterfall Precinct as well as in Sandton, and now also looking at stuff in Cape Town. So Jonathan, just moving forward again on strategy. I mean, we have over the last couple of years had a pretty focused approach to reducing our debt and bringing down our loan-to-value ratios. Our absolute total debt number in South African terms has reduced from 42 billion of debt to in the order of 36 billion. And we've achieved this effectively through asset disposals, mainly in the South African portfolio, but also the disposal of our UK investment. So on the gearing side, I'd say we're probably better positioned today than we have been in the last number of years. We've got ample liquidity and access to debt facilities. 5.7 billion rand worth of debt facilities available to us. These are committed facilities we can draw down on pretty much at a day or two's notice, providing us with ample opportunity for investment. As we move on to the front foot a little bit more, using some cricketing terms, the last couple of years we were more defensive and on the back foot, but we have moved forward onto the front foot recently, looking at expansion and investment opportunities both domestically and internationally. But the international mainly focused on optimizing our existing investments. We have 500 million rand of cash on the balance sheet at the year end. Always joke with Growthpoint, it's not about cash. We either got more debt or less debt. So generally we use any excess cash to bring down our debt balances. So it's not about having a big cash balance. And then lastly, with the payout of 87.5% of our profits, we are retaining about 321 million rand. And that in essence is cash retained for the benefit of our existing South African portfolio and then maintaining the portfolio, spending maintenance capex. Our annual run rate there is about 600 million a year. So we hold back on some of the profits that we make. We don't pay everything out to investors, keep some back for our maintenance, and ultimately that talks to a very sustainable business model for Growthpoint. Moving forward to the next slide. This just continues to deal with the optimizing of the South African portfolio. We sold just under R1 billion worth of assets in the period. On the other hand, we've invested probably about 550 million across a number of initiatives. I'd say a fair bias here towards the Western Cape, which is where we're seeing some of the growth coming through. Some of the markets, especially the office market in Gauteng, still being a bit challenged. Moving on to the next slide. Cumulatively now since July 2016, when we started let's call it the optimization process, we have sold over 200 properties worth almost 16 billion. About 5.6 billion rand worth of office properties were sold, 4 billion of retail, 4.5 billion of industrial, and 1.7 billion of trading and development assets were sold. So in the process, we have sort of changed the composition of the portfolio, where we were very significantly overweight office, with 46% of the portfolio office back in 2015, 2016. We brought that down to 42%. In the process, we've increased the allocation to the industrial sector from 15% to 19%. So a big ship, and not that easy to change these percentages overnight, but it's steady as she goes, and it's an incremental process annually of identifying the assets that no longer meet our investment criteria and that are unlikely to provide the kind of growth that we look for in terms of our total return analysis, and selling the older assets with less prospects of growth, and recycling that capital into newer, more modern assets that will in growing nodes that should hopefully provide better growth in the future. Next slide. Just on the international side, it's interesting how over the last couple of years, certainly in the last year or two, we've seen unfortunately the contribution from our international businesses come off a little bit. The South African business performing better than international in the last year or so. But that is a turnaround from probably 2-3 years ago, when the South African business was under a fair bit of strain, given the challenges of load shedding and an economy that wasn't growing. That seems to have turned around a little bit now, with the South African prospects looking a bit better and coming through in the numbers. And the international businesses slowing down a little bit in terms of their contribution. But still 35.8% of our total assets are located offshore, producing 22% of our distributable income. In terms of the two major remaining investments that we have, Growthpoint Australia, or GOZ, remains a very core investment for us. We still very much like the dynamics of the Australian economy, even though in terms of cycle, it is a little bit lagging a little bit at the moment relative to SA and some of the other global markets, mainly driven by the fact that they haven't quite gotten to the in terms of an interest rate cycle, gotten to a point where they're cutting interest rates. To the contrary, they've actually been increasing interest rates. Earlier this week, they pushed their interest rates up by another 25 basis points, and that's their second increase that they've had in the last 3 months. So they're sort of out of sync with the rest of the world, but we do believe it's just a matter of time, and that'll turn again. So our total foreign denominated income was just over 500 million, 554 million. The other offshore asset that we have is Global Worth, and that produced just short of 70 million of dividend for us in the period. Unfortunately, that was down compared to the prior comparable period as well. But fundamentally, still a very solid business, giving us exposure to the office market in Eastern Europe, principally in Poland and Romania. Just moving to the next slide. So in terms of analyzing the performance for the period and trying to just sort of understand what the moving parts were and what gave rise to the increase in our profits. It's fair to say from this slide that the South African business contributed positively, 69 million rand increase in total contribution from the South African business during the period. But the big contributor there, in fact, being reduced finance costs. So as interest rates have come down over the last 18 months odd in South Africa now, given our level of debt, we've managed to bring down our total interest charge in the income statement. That was a positive contribution of over 200 odd million. Our contribution from the V&A waterfront was flattish for this half-year period. We are, however, predicting that for the full year, we should get double-digit contribution growth from the V&A waterfront as we stand to bring in some profits from the residential sales in the V&A waterfront. As I mentioned earlier, the contributions from the offshore businesses were negative, down 48 million for Australia, and down 96 million down on the Capital and Regional and New River contributions. That effectively linked to the fact that we sold those investments and didn't get any contribution in this period compared to the prior period. Global Worth was down 60 million. Our dividend per share that Global Worth delivered was 7.5 cents a share, and in the prior period it was down to 5 cents a share in this period. Translated into rands, that gave us 60 million rand less. Dividend from Lango, we didn't receive any in this period compared to 11 million in the prior period. And then GIP is our Growthpoint Investment Partners business, or the fund management business, third-party fund management business, and that was up by 24 million. And then our trading and development business had a relatively poor contribution, linked to the fact that, when times were a little bit tough and capital was a bit more scarce, a couple of years back, we did choke back on putting assets or opportunities into the pipeline of the trading and development business. And these sort of property development opportunities generally take 12 to 24 months to come to fruition. So we've seen less contribution, but we have been pretty active in putting some more assets into the pipeline going forward as we're feeling a bit more positive about the future, certainly the future of the South African business. So, John, I'm going to ask you now, there's a lot of numbers on the next couple of slides, and I'm not going to delve into the details of those numbers, but what I'm going to ask you to do is to go all the way forward, because I know investors generally like to hear a lot about the V&A waterfront and what's happening there. So there's slide number 38, bottom right-hand side of the presentation, deals with some of the highlights of the V&A waterfront. Just one more. There we go. Yeah. So, and I understand I've got about 5 or 6 minutes left to present, and then we move to questions. But yeah, waterfront, obviously, arguably the most iconic asset that Growthpoint owns in not only the South African context. I'd say the waterfront stands out in a global context as a trophy asset. We own 50% of it in partnership with a PIC. And it is effectively 510,000 square meters of developed bulk. And as you will, for those of you that know the waterfront, it comprises hotel properties, residential properties, industrial properties, office properties. We get income from mooring, ships mooring and harboring there. And then also the big retail shopping center. So for the period, in our valuation, our half piece is worth about 14 billion. So for the period, the net income grew at 1.9%, which is disappointing relative to history, but it reflects the fact that we closed down 2 properties within the waterfront, essentially for refurbishment and redevelopment. The first one being the Table Bay Hotel, which underwent a very major refurbishment, and we had zero contribution, in fact negative contribution, from the Table Bay Hotel for this period relative to the comparable period. And then we also closed down a section of the shopping centre mall. We call it the Lux Mall, where we're in the process of bringing in some of the large international high-end brands like Louis Vuitton, Gucci, and they'll open towards September. So if you eliminate the impact of those let's say unusual closures, the like-for-like net property income grew at 8.7%, and the net property income from operating businesses grew and now represents 16% of total income. So it's been a deliberate strategy at the waterfront to expose ourselves more to the operating entity. So rather than just get a rental check every month, we've effectively structured our leases on the basis that we get and we take some operating risk with the operator, mainly driven by the hotel and the hotel investments. And today that represents about 16% of the total income from the waterfront. Vacancies at the waterfront are I guess, next to 0.3%. Essentially, the precinct is fully let. And we've seen very significant growth in tourist numbers coming through Cape Town International Airport, and invariably they find their way one way or another to spend some money at the V&A. December alone, we saw 3 million visitors at the V&A, which is 4% up on the prior year. And for the full year to December, we saw over 25 million visitors at the waterfront. Very big contributor to the financial results for our second half is going to be the sale of the residential units at the 5 Dock Road development. And there are 98 units. In fact, the slide is already out of date. There's only 1 unit left unsold, and we've earned significant development profits at the waterfront from these residential units, with GP margins, gross profit margins, close to the 40-odd% level. Moving to the next slide, Jonathan, just on the funding. So the waterfront has been funded by the shareholders, Growthpoint and the PIC, up to a couple of years ago. We hadn't introduced any third-party debt into the waterfront, and in recent years, certainly the last 2 or 3 years, we've started introducing third-party bank debt, and we currently have about 4.8 billion rand worth of debt against this 14 billion rand asset. Oh, sorry, the total combined value is 28 billion. So the 4.8 billion is 100% of the debt. We only sort of own half of that, if you want. Most of the debt is variable. 72% of the debt is variable. The rest is fixed. And again, we have significant facilities, undrawn facilities there in the order of 600 million. Our average interest rate is 8.3%, and the total interest expense was 170 million for the period. I'm not going to go into each one of the different segments of the performance of the waterfront, but if you just slide through or page through slowly, Jonathan, to the next slide, we do have some information there on our retail portfolio and the office portfolio and how it's performed. Onto the next slide, the hotels performing particularly well. We've got a new hotel that should be opening in, so that the refurbished Table Bay Hotel opened, 200 of the 300 rooms opened in December. The other 100 will open now in April. And then there's a new hotel called it's going to be known as the Cape Town Edition Hotel. It's part of the Marriott Group. That'll open in September, and that's about a 142-odd room hotel. So very significant investment into the waterfront. These 2 hotels collectively close on 2.5 billion rand of investment, and positioning the waterfront favorably for growth going forward. Quickly onto the next slide, which talks to the additional rights. What we've managed to achieve in consultation with the city is the awarding of these additional rights, which essentially secures the future growth of the waterfront for the next 10 years. The rights are a mixed basket of rights. Essentially, it'll be led by residential. Half of the rights we are obligated to build residential properties, and the balance will be across multiple, let's call it different asset classes in the form of office, some retail. We're contemplating some later living and aged care assets there, as well as the zoning does provide for us having to produce some affordable accommodation there as well. Right, so I'm going to stop there, given the time. It's just over half an hour in. I guess I've highlighted the key important aspects, of the results, and hopefully given you a slight overview of the makeup of the portfolio and the business. And I'd be very happy then to move to the question and answer session of the presentation.
Norbert, thank you very much for the presentation. Yeah, good. I think one-on-one overview of the business and some exciting developments, as you touched on, with the expansion at the waterfront. And maybe we'll start where you finished. And given this is I've seen various numbers in the media, but it's a decade-long project. Let's say 20 billion rand has been kind of bandied about or thereabouts. How do you balance the investment that's going to be required there over this time period with investments in other parts of the business, growing dividend per share? Just talk us through, because it is such a huge project, how that flows into decisions in other parts of the business.
Yeah, so good question. I mean, clearly, as we move forward and understand our cost of capital and look at capital allocation, it's fair to say that right now the Western Cape is probably grabbing a slightly disproportionate share of the pie, in that that is where we see the better growth prospects, not only in terms of prospects, but certainly in terms of real actual performance. Over the last couple of years, we've seen a significantly better performance coming out of our Western Cape portfolio. Outside of the waterfront, we have another 23 odd billion rands worth of assets in the greater Western Cape, across retail assets. We've got some really standout other retail assets like the Constantia Village Shopping Centre in Constantia in Cape Town, the Garden Shopping Centre. We've got Paarl Mall in Paarl. And then we've also got industrial and office assets, a very significant portfolio of office assets. Now, our office assets have been struggling over the years, but the Western Cape, once again, is actually doing particularly well. And again, if you isolate the waterfront has had zero office vacancy for the last sort of 5 years, even post-COVID, which is an exceptional performance considering what's happened to office properties and office investments over the years. So I think we consider the allocation of capital relative to the future returns that we think we can be getting there, and undoubtedly the waterfront, because of its bias towards tourism and the growing tourism business within the Western Cape, we think we're going to get superior returns coming out of the waterfront. It has got significant gearing capacity. So I highlighted a number there earlier, 4.8 billion rands worth of debt at the moment on an asset value of about 28 billion. We feel the waterfront run rate in terms of investment for the next couple of years is somewhere between 2.5 and 3 billion a year. Bearing in mind that's 100%. We only are liable for effectively 50% of that. So from our perspective, 1 to 1.5 billion a year towards the waterfront. But we feel we can gear the waterfront asset, for the immediate future, certainly the next 3 years. We could debt fund whatever requirement the waterfront has for certainly the next three to 4 odd years. Just simple math, if we're adding, taking currently, make it a round number, 5 billion of debt on a 28 billion of asset. If we add 10 billion of assets to the five and we fully debt funded, that's 15 billion of debt. You should be getting at least a rand for rand on your investment. So your 28 goes to 38. So you're still sub 50% loan to value, even spending another 10 odd billion at the waterfront. So we're not that concerned, if you want, about how we fund it. We think the banks are very keen to provide debt funding. In fact, some of the margins we get at the waterfront are as good, if not slightly better, than what Growthpoint gets as a corporate, just given how good the covenants are and the quality of the product. I hope that answered your question there, Don. Sorry, Mark.
That's fine.
Hi, Norbert, Finance Ghost here. Thank you for joining us on the platform. Welcome, everyone. So when you were giving those footfall stats for the V&A waterfront, I couldn't help myself. I Googled Venice. And if what I found online is correct, then the footfall annually at the waterfront is roughly similar to Venice, which was a mildly astonishing thing to Google. I hope that stat's right. I believe yours. I'm not sure I believe the Google one, but it seems incredible. I guess what I wanted to raise is just maybe it sounds ridiculous, but the busyness of the waterfront. So I ran a poll in GhostMail recently, and 64% of respondents said invest like mad there. It's the best asset we have. And 36% said, listen, this is too busy. Calm down on the investment there. Now, obviously, you've got the stats. But I guess for investors who are looking at this and saying, wow, the waterfront is incredibly impressive. There's a lot of good stuff going on there. It's becoming almost quite a lumpy source of revenue for you in some respects with the residential developments alongside all of this. I guess the concern would be, okay, how big can it get? What could go wrong along the way? So what do you do to address these risks? Because I read a lot of stuff in the Growthpoint commentary around like a precinct lens now and trying to manage an area. So what does that look like in practice with city management, with traffic, with managing density, etc.? Because if the stats are to be believed, you basically own half of Venice here on the tip of Africa.
Yeah, it's an interesting stat that I would have thought. I thought you might say it's equivalent to 1 month's visitorship in Venice as opposed to a full 12 months. Because I do know some of the stats. Paris, for example, as a city, I think they attract 120 million visitors a year or something like that. So the waterfront is actually relatively small. Yeah, look, it is a fine balance. We understand that there are some concerns around the level of activity, and as we interact with management at the waterfront, we have been urging them to plan, I guess, the rollout of the new investment, in such a way that you don't end up making the visit to the waterfront an unpleasant one because you feel like you're on a construction site. So I think, right now we've got a bit of a concentration in that Table Bay precinct where the Table Bay Hotel is, and it has caused some disruption. And it's also, the construction of the new stuff there also coincides with a need to spend considerable amount of money on infrastructure renewal. The precinct is about 25 years old. So many of the, let's call it the underlying infrastructure, water pipes, electricity, reticulation, etc., is in need of upgrade. And as we've moved effectively off the water grid, when we switched on the what's it called, I've just gone blank a little bit now on the name of the plant, seawater plant, where we desalination plant, where we now taking seawater and desalinating it through a process and feeding that into the V&A waterfront. It essentially means we're off the grid from a water perspective, certainly to the extent of at least 80%. 80% of the water in the waterfront today is supplied from the desal plant. And we've reduced our reliance on the city. But that infrastructure and that change also, again, had the need to, introduce new underground water pipes, etc., etc. So, It has been a particularly busy period. I think we are monitoring the impact of the activity, and I think in terms of scheduling new developments and some of the infrastructure upgrades, going forward, we're probably going to be a bit more mindful of the impact of that on the visitor. But it certainly hasn't detracted whilst there might be some negative commentary, the numbers speak for themselves. Turnover at the waterfront in December reached an all-time record high, 11 billion rand worth of, 1.4 billion rand worth of turnover at the waterfront for the month of December. That was up significantly compared to the prior year. And on an annual basis, over 11 billion of turnover at the waterfront. So still seeing growing numbers, growing footfall. We've seen a particularly strong tourist season. Hotel rates were significantly up on prior year. And so, look, we think that the waterfront still got legs. With additional rights, bearing in mind the initial parcel of rights that the waterfront had was about 660,000. We've got another 440 now, taking it up to 1.1 million. The bulk of that is actually going to be spent on what we call the Granger Bay precinct. So this is the precinct at the waterfront, which is the furthest away from the city and towards Mooley Point. If you look at the density effectively of that precinct compared to some of the stuff we've done over the last 5 years at the Canal precinct and the Sino precinct, there's definitely significant scope there for increased investment, whether that be in the form of residential, hotels, commercial, retail, or other. And the traffic, is an issue, and certainly in getting the additional rights from the city, traffic assessment, traffic impact assessment studies needed to be done. There is a bit of a pit stop in terms of the rights that says after the first 200,000 square meters of bulk, we need to do another traffic assessment, to ensure that that we don't end up in a precinct that is completely gridlocked for most part of the day and night. I'd say on the traffic front, Cape Town itself as a city has got traffic challenges. Often people complain about the traffic in the waterfront, but it's because they can't get out of the waterfront because the other roads like Buitengracht Street and various other streets are blocked up and the motorway is jammed. So the one sort of unfortunately is impacted by the other. So it's more of a city challenge to my mind rather than a waterfront specific challenge when it comes to traffic.
Norbert, I should just declare a small shareholder in Growthpoint. I was voting yes in that poll in Goat Mail. I strongly believe in doubling down on your winners. So yeah, put to the floor at the V&A waterfront. You touched on the desal plant there, and I do want to talk about it. Among other things. Water and solar projects, we've heard from other REITs that have been on here, just given, not so much in the Western Cape, but if we go to places like Gauteng, operational risks for assets and tenants, costs, right across the board in terms of, the cost for water and electricity coming through, maybe not directly from the city, but from Eskom. I mean, should we expect to see more of these, wheeling deals? I think you guys are one of the first ones to do a wheeling deal as the Eskom unbundling progresses into more municipalities, more cities. Will we see more of those unbundling deals and more things like the Boston plant? Doing not just doing deals with independent providers, but investing in your own capacity.
Yeah, I think short answer I get to that would be yes. I think more and more, and especially on a precinct kind of a approach, that we're looking at the moment. We think that it's important to invest in the underlying, almost like utility, if you want to call it that. So waterfront, we've done what we can on solar. We've gone heavy into the water situation with the desalination plant. That plant is spec'd for 5 megaliters. We're currently only doing 3.5, I think, or 3.3 million liters a day. But it can be, it's been spec'd to upgrade to 5 million liters a day without any material further investment and or disruption. I think, going forward, these kinds of investments, not only do they make commercial sense, but they end up de-risking, the project or the asset or the precinct significantly. So I do think, there'll be a greater focus going forward. We have, as you point out, been, at the forefront of not only installing our own solar. I think we've got 61 megawatt peak installed at the moment, with another 7 to come before the end of the year. So I think we'll have circa 68 megawatt peak installed by 30 June. That, together with our power purchase agreement, takes us to approximately 40% of our baseline consumption in 2023 from renewable energy sources. So under the power purchase agreement, the first bunch of power is already coming through in the form of the what's being produced at the hydro facility. The next tranche is 2 wind farms that are they've already reached financial close, and they'll probably be switched on by the end of 2027. We'll be getting that power coming through. And then there are, I forget what the other component of the mix is. There's also another solar, which is not owned by us, as part of the mix that we getting from Etana, the energy broker. By 2028, we should have at least 40 to 45% of our total energy consumption being supplied effectively through or from green energy sources. We do see, an improvement in regulation coming through as well. At the moment, in the Western Cape, we're able to wheel, let's say, electricity generated on one property. We did a test with the City of Cape Town where we were generating electricity from a solar plant at the Constantia Village Shopping Centre, and we were able to wheel that to effectively for 91, who an office tenant in the foreshore. Now, not all municipalities allow that or cater for that. So in the Western Cape, we can do that. We have ample capacity on some of our industrial assets where we can still add capacity. And if we can start wheeling, from the industrial asset to an office asset, that opens up another avenue for us going forward. But we do need, some of the regulation to change, in some of the other provinces and the other cities. But we feel confident that, going forward, it'll be a feature of ours, not only de-risking, as you point out, on the electricity side, but also on the waterfront. We've done a fortune of work in the last year, in terms of tapping into boreholes where we possibly can, installing water tanks at most of the properties where we've had challenges with water supply in the past. And then clearly looking not only at de-risking, but on the other hand, at consumption as well. So we've got new targets set for the business, ultimately linked to the remuneration of the executives, which talks to reducing water consumption. Again, having drawn a baseline in 2023 and looking to introduce, various measures to reduce consumption, in addition to just the de-risking side of things.
I'll jump in there with a question from the DMs, Norbert. So this is going to be, I love seeing questions like this because 10 years ago, everyone wanted to know how money was leaving South Africa. And now everyone wants to know how it's coming back. So that shows how much things have changed here. And the question relates directly to the offshore investments, Lango and GWI. Specifically, I mean, look, there's some points in the question around it seems a bit value destructive at the moment. Where are these things at? What are we doing about it? Can you sell them, bring the money back, reduce debt? How are you thinking about that? Obviously, the opportunity cost of debt in South Africa is still high. We're a structurally high interest rate economy. So, to have equity stakes somewhere, they've got to be beating that by a decent margin. I guess I'll let you then comment on it to the extent you can, obviously. Where's the thinking at with these assets and bringing that money home, bluntly?
Yeah. Yeah, look, so I mean, they've all got different challenges, I guess, specifically Globalworth and Lango. Global Worth, is it's got exposure to Polish and Romanian office market. Now, fundamentally, the operations and the assets are not performing badly at all. Romania, I think we got like 95% occupancy, and in Poland, it's a bit of a tale of two stories there. One is the Warsaw market is pretty healthy. But we've seen some biggish vacancies in some of the smaller cities in Poland where we've got exposure. And again, I try and often provide a bit of perspective. You might see a print of 30% vacancy in our portfolio in, let's say, one of those smaller Polish cities. But in context, it might only be 20,000 square meters. So it's not, we're not talking hundreds of thousands of square meters or millions of square meters here, and it only takes a couple of letting deals to get that number down by half. So we fundamentally still are believe in diversification, international diversification. It's interesting how things have changed. As I said earlier, the international businesses were carrying the SA business when things were tough in SA, and now we've seen sort of the reverse, where the SA business is carrying the offshore stuff. We think that the offshore business, certainly Globalworth, probably bottomed out in terms of the cycle that they're in. Impacted quite heavily with still high interest rates there on some of the bonds that the company has in issue. It was unfortunate that it had to refinance its entire bond book in the worst possible time of the interest rate cycle, about 18 months to 2 years ago. Finance costs went from 3% to 6.25%, and that's had a pretty negative impact on the dividend. But the underlying performance of the hard assets is actually pretty good, and we do still like the, let's call it, diversification into Central and Eastern Europe. Perhaps we'll consider diversifying and not having all of it in office, and looking for some other sectoral exposure in those markets. Lango is going through a bit of a tough time at the moment. You saw some significant currency devaluation of the Naira and the Ghanaian cedi against the US dollar when the interest rate cycle blew out. The underlying assets are probably as good as you're going to get if you're looking for commercial property exposure in Africa. In the short term, the gearing's a bit high, and the company has decided not to pay a dividend. But there's a realistic prospect there of the company raising some additional capital, bringing down the debt levels, and ultimately starting to get some dividends coming through from the Lango investment as well, hopefully in the next 12 to 24 months. But yeah, right now I'd say in terms of the cycle, in terms of capital allocation, things are feeling a lot better in SA, and in terms of the incremental rand at the moment, probably be invested in domestically, and any capital being going offshore, probably towards supporting the existing investments we have, rather than new investments in any other jurisdiction offshore at the moment.
Mark is very graciously giving me back the floor, because I have another question in my DMs. I wonder if this will be the last. Let's see. It basically relates to just confidence returning to the Sandton market, essentially. So now this is as residential, not necessarily office. I mean, obviously COVID, I think Growthpoint would have been one of the most impacted funds, I would imagine, by what happened there. It was hard to watch. I mean, I worked in Sandton a decade ago, and you go back there, it was just nothing like that. So you obviously are feeling more confident about Sandton again, at least from a residential perspective. Maybe just some commentary around that, because all the focus is always on the waterfront.
Yeah, look, I think Sandton has got, it's arguably still, one of the foremost commercial precincts, if you want, in Gauteng. Still a financial sort of hub. I know there's some challenges, from some other precincts like Waterfall. But fundamentally, I think, Sandton's still a very strong node. Very big population in the immediate adjacencies to Sandton in the other suburbs. So look, the office market, I think, is still a little bit challenged, considering the, let's say, the lasting impact of work from home, which is still playing out, hasn't quite worked its way through the system yet. So with office vacancies still in double digit, probably going to be a little bit weak for another couple of years. The resi, I think, is very sort of, in fact, there are a number of developments going on, and interestingly enough, anything from affordable to high-end residential accommodation. So there are quite a few cranes up in Joburg again. I'd say the bulk of them are effectively for the construction of residential, but more in the affordable space. And then, with our exposure to land and having owned the land around the Discovery site or Discovery building for a couple of years, and the new development that took place there with the Cavaleros Group doing the retail centre on Rivonia Road, there's evidently a very, very big demand, for high-end residential in that node. And so we've taken a view to partner with arguably one of the best operators in that space, the guys from Tricult. And we're pretty optimistic. We've seen some very significant pre-sales. Over 60% of the value of the portfolio of the scheme is essentially pre-sold. And we think that bodes well for Sandton and the Sandton CBD, going forward. So you'll see a return to the office. You'll see more densification and residential, and catering for lower and high end market, which we would argue is generally going to be very positive for the Sandton market as a whole.
Robert, I'm going to squeeze one quick one in here. Even though I see Vanessa is trying to wrap up with just a quick one. A bit of a tick up in the payout ratio in this latest result, but we're still a long way off what was pre-COVID times in terms of payout ratios for Growthpoint. So maybe just quickly, how should we think about, are you trying to get back to where you were payout ratio wise pre-COVID, or should we expect a kind of medium-term target depending on results here, their currencies in that 80 to 90% range if you take a 3 or 5 year view?
Yeah. So I think the way we've approached the payout ratio, and I'd have to say that what transpired before COVID, to my mind, was probably not sustainable. We were all on the wheel, chasing dividends and dividend growth and earnings growth, I guess, which is normal. But I think we got to a point that wasn't sustainable. Our view on the REIT model is that to be sustainable, you got to at least hold back some money, if nothing else, just to cover your regular maintenance capex. Now, the rule of thumb for listed property companies, or certainly Growthpoint in our portfolio, is that about 1% of the value of the portfolio gets spent on maintenance capex on an annual basis. This domestic South African portfolio, ex-waterfront, it's about 66 billion rand. 1% of that's about 660 odd million. And that's the number that sort of we try to retain from with a payout ratio less than 100. So at 87.5% payout ratio, we're retaining, I think for the half year, the number is 313 or 330, I forget the exact number. That's half of the 600. And, that to our mind makes the business model sustainable. You cannot sustainably pay out more than your cash and keep borrowing. So it all worked well when asset values just kept growing and your LTV would stay the same every year because you take on more debt, but your asset value would rise. And so your LTV didn't really move much higher. And then and then it didn't. And then asset values started coming down. I mean, office values from peak to trough were written down by close to 30%. And so before you open your eyes, your LTVs are 50% and north of that, and that's not a place you want to be in. So our view is that, what informs our view on the payout ratio is the need to retain some cash for the maintenance program. And we feel comfortable that, the number in the high 80s there, maybe nudging a 90, is about right for us. So we don't foresee going back to the hundreds that we saw before. I know some of our investors are unhappy about the fact that there's some tax leakage because of that. We're aware of that. We try to find mechanisms to reduce the tax leakage to the best as we can. But for the interim, we're going to be sticking with that payout ratio range.
Okay, perfect. Norbert, we leave it there because Vanessa is now giving me the debts there to finish up here.
That was such a lovely discussion. Thank you, Norbert. And thank you also to everyone who chose to spend time with us today. And a special thank you to Norbert and our team for making the time to support the platform and to engage with the retail investors. Our next session of Unlock the Stock takes place on Thursday, the 26th of March, and that's with another returning company at TAC. So that is all from my side. Thank you very much. Goodbye.